Did you know that India is one of the largest consumers of gold globally? Yeah, I was surprised too. Historically, gold has generated a return between 9 to 12% depending on which time frame you take. And gold is typically considered in an investment portfolio for its diversification benefits and its low correlation to equities. In India, you can invest in gold via buying a physical gold, or buying digital gold, investing via mutual funds or ETFs, which is what we are going to discuss today. Or you can also invest in sovereign gold bonds, which is backed by the Indian government. Now that we understand the broad landscape of gold in the Indian market, let's get into the analysis of one of the largest gold ETFs in India, which is the Nippon-India ETF GOLDBEES. So the first thing that strikes out to me is the diversification score. So it is ranked between 0 being the worst and 100 being the best, and it is around 70 now. So it is high on diversification, and the reason it is high on diversification is because of its low correlation to stocks and bonds. This is probably the best chart to understand the full potential of gold as a diversifier. So what this chart is showing is, if one adds 25% of gold to a portfolio of Nifty 50 with 75%, your drawdown gets decreased by about 11%. Your CAGR increases by about 0.6%, and because of virtue of high CAGR and low volatility, your Sharpe ratio increases by a lot. So I think that's great, right? Correlation, again, what we saw in this chart, low correlation to stocks, that's what we see here too, right? So correlation to Nifty 50, which is the equity market, right? It's between 0.3 to minus 0.3. So on average, it seems to be hovering around 0, right? So the correlation to equities are pretty much 0 here. So what we understand from this is that gold is a great diversifier. It has reduced drawdown, it has increased your returns, as well as by virtue of these two, it has increased your Sharpe ratio as well. Seems like a great diversifier from an analysis point of view, right? Now that we understand these things, now let's get into how gold has performed during stress periods, because during these periods is where you expect your diversifiers like gold to do better than your equity portfolio, right? So during financial crisis, you can see your portfolio with Nifty 50 would have been down by 45%, whereas your gold fund or your gold allocation would have gone up by 70%. That's a lot, right? And even during COVID-19, right, the recent crisis, your Nifty 50 would have been down by 32% compared to gold's 10%. Same story follows in the rolling drawdown as well, where Nifty 50 would have gone down by again 53%, whereas gold is barely around 20%. So from both these analyses, we understand that gold seems like a great diversifier. It has during these stressful times, it has done well, it is battle tested, and seems to have generated great returns during almost all stressful periods here, except tapered random. Again, it's better than the Nifty 50, but in almost all stressful periods, it has generated positive returns and more returns than the equity markets. Let's quickly, so I've compared the largest ETFs in India. So you can see the same gold price here, because all funds are tracking the same gold commodity index, right? So you don't see an outperformance or any sort of thing. This is not an active fund. One thing I want to point out is the fees of Nippon India GOLDBEES, which is around 0.8, which is on the expensive side because it's tracking, it's not doing any active management. So 0.8 seems to be on the higher side compared to other ETFs where they are charging 0.5%, 0.6%. I've also found a couple of ETFs in India which charges about 0.3. So these ETFs are the lowest in the Indian market when it comes to gold, right? So Mira Asset and Zerodha Gold ETF are the lowest expense ratios when it comes to the gold ETF category, right? I think what we have learned from this video is that gold seems to be a great diversifier. It has a high diversification score, low correlation to stocks and bonds. It has increased your CAGR, decreased your drawdown, as well as increased your Sharpe ratio by virtue of CAGR increase and volatility decrease, right? And we have also seen that during stressful periods, it has done amazingly well compared to an equity portfolio. Also, we saw some of the funds that are charging lower fees in the gold fund category. I hope you enjoyed this video. Thanks a lot for watching. See you next time.